Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend Sam Clement. Sam, say hello.
Hey, John, how are you doing?
Sam, I'm doing very well. Doing very well, and I hope that you are.
I can't complain
Well,
right now. I mean, it's
know-
getting warm around here.
Well, there you have it. People are getting a little spring fever here in central Alabama. However, I will tell you that I think there's a group of people out there, and we are all members of it, that might not be feeling as awesome as they would like to feel. And that's really, for all intents and purposes, the U.S. consumer.
You know, we've talked about this kind of on and off for a while, and, you know, the discrepancies in data versus what people are feeling and anecdotal. And, you know, I think at times I've said, you know, I think the consumer can probably be a little too pessimistic, but, you know, the economic data has largely been pretty robust, I would say. I mean, for the most part. And so there's these wide discrepancies. And I'm not saying every data point's been great, but, you know, unemployment's still really low. The jobless claims are still really low. And consumers are pretty negative and have been pretty negative.
It's been confounding, really, about the last 12 to 18 months worth of economic data. Huge vagaries in the household data and the establishment data within the employment situation report. What people believe the direction of the country is relative to what the government has been telling us the economy's been doing. Just all of these things, it just didn't really make any real sense. I mean, certain things just anecdotes that I have either personally experienced or articles that I've read. 90% of Americans are concerned about their grocery bill, and some ridiculous percentage of Americans don't even have $1,000 for a rainy day emergency type thing. And so you really do get this feeling that a vast majority, a plurality, whatever you want to say, of Americans really truly are living paycheck to paycheck, and these economic numbers that are coming out from Washington are heavily skewed either just to businesses themselves or to the people that own them, but really aren't coming down to the common person.
Well, I think that's it, and I'd add one more thing to that it's not flowing down to, and it's the top 1% and top 10%. I mean, we get more and more data. We know that we're a consumer-driven economy, but the consumption, I think it's close to 50% now comes from the top 10%. So that alone skews the data significantly when you're talking about, okay, what does the average American feel? Well, the average American isn't in the top 10%, yet that top 10% accounts for such a large percentage of what's being measured, of the GDP, of the consumption. And so I think that's a lot of where the disparity comes from. We've talked about it with inflation data. You know, inflation's great for asset holders, right?
Yeah.
And, if you're borrowing money, just so the impacts get real skewed on who benefits from inflation and who is punished from inflation.
Hey, listen, if you don't have any revolving rate debt and you've got a 100% equity in commodities portfolio, bring inflation on.
Sure.
However, if you've got any sort of revolving debt and you don't have any money in the market, inflation sucks.
And the ultra wealthy and not just wealthy in general, a lot of which have, if they have mortgages at all, have them at 2%. And so inflation's great again.
Fixed rate stuff.
You have these people saying, I will never pay my mortgage off. I don't want to.
Listen,
and your assets are going.
You're talking to someone.
Yeah, same here. And so you have these, it's just extremely skewed. And I think that's a big part of it. The food inflation has not really impacted the top 10% in the same way it impacts the bottom 10%.
Well, and then that's what we're seeing. And part of the reason why I have contended for a while that, the problems in the country are less economic and more societal in nature. And the fact that, hey, the top 10%, as long as they're continuing to spend money at 20%, the economy grows 2% if everyone else just doesn't go belly up. That's just the way the math works. However, there are just enough little anecdotes out there, and it's the second time I've used the term, enough anecdotes out there for me to think that it all can't be anecdotal, if you catch my drift.
Yeah.
It's just the number of restaurants that are closing down. I've read that. I mean, Hooters is going to be exploring bankruptcy. I think TGI Fridays. A lot of these sort of fern bars, and then like Denny's is closing down restaurants after restaurants after restaurants. Cracker Barrel's having to completely redo their menu to try to get people to come back into it. And I throw these restaurants out there. These aren't fine dining establishments at all. Most of us have been to them, although I will say I haven't been to a Hooters in quite some time. I was a much younger man the last time I went to one. But I will tell you that they are kind of like, that's the middle class sort of stalwarts, just sort of the good old fashioned, hey, where are you going to go to get a decent meal out and maybe a cold beer? You go to TGI Fridays. You want some.
I'd say that's
type
skewing
stuff.
onto the lower end of middle class.
On
average, in
I think
terms of their target market.
I think it all depends on what your definition of middle class is.
Okay.
And so I would say it's just that just sort of good old fashioned. Old fashioned's not the right word, but to me, when I think of middle class, I think of that. Just kind of second and third quartile type person.
Yeah, but and then on the flip side, you're seeing, at least, again, going back to some anecdotal stuff, nice high-end restaurants are continuing to open up and continuing to do well. I mean, there's restaurants I've tried to get into that, it's like, hey, 6 weeks out minimum.
Yeah.
And, that new restaurant is now a year old, and guess what? 6 weeks out. I mean, still...
here in town, you try to get into Bottega,
Yeah, it's
several weeks out,
yeah.
And you try to get into even Chez Fun Fun. Several weeks out. And Automatic Seafood and some of these other places. Takes a long time to get in there, and it's all generally a kind of a well-heeled clientele there. But you go to other places, and my Lord, it's just like, hey, where are the lines, And last year I wrote a little bit about I will know that the U.S. economy is getting ready to fall apart when I go to the Cheesecake Factory at 5:30 on a Saturday afternoon and no one's there. Folks are still there at the Cheesecake
I was about
Factory.
to say, I saw it at like a 2 in the afternoon.
It's still there, and it still baffles me. Nothing against it, but the love
it's a head scratcher.
The love that company gets is crazy. Food's fine. Don't get me wrong. I'm not dissing it, but that like that, heavens to Betsy. No, but I go through all this, and you go through all this because when some of the data I've seen recently does really suggest that the economy, the U.S. consumer might be at the end. We still have the uber rich, the 1%, top 5% still spending a decent amount of money. But when I take a look at the Conference Board's expectations and take a look at how much that has fallen since the election. The Conference Board's consumer confidence number just shot up like a rocket after the election. Just went way up, and now we're back down to levels, seen before the election.
Mm-hmm.
So kind of fallen apart pretty significantly. They were seeing the personal savings rate fall to 3.3%. Not an all-time low, but we're getting down into that level where, hey, people are spending pretty much everything they have.
Yeah, and we've seen it in the announcements from some companies. That
Walmart's a perfect example.
Walmart, even into home builders. The publicly traded home builders are not necessarily building homes for the ultra wealthy. I mean, by and large, I get that's paint with a broad brush, and they're experiencing some weakness in demand from consumers, and so. Prices have continued to go up. We still have a lack of supply in housing, or a gap there.
Yeah.
And so I'm not sure how it gets solved. And, when you're talking about, the data can be very easily skewed. If 10% of people are impacting 50% of anything, it's going to be skewed.
Yes.
Because then you think, okay, if the top 10% is 50%, that next 10% is not going to be the other 50%, but they're going to be a big chunk of it too. So you're having a sizable majority of consumption coming from the upper quartile.
Yes.
I don't know the exact number for that. I know it's around 50 for the top 10%.
And I would say it's probably really that top 10%, maybe even that top 5% that's really greasing the rails.
And they have not slowed down at all. Maybe a little bit, but why would they slow down? Asset prices are pretty much at all-time highs.
Well, what's crazy about it, is they're continuing to spend money. They're just spending money differently. If you would take a look, the top-end consumer is spending a lot more money on things like experiences, travel, upper-end restaurants, what have you. High-end furniture, they're not spending any money on that. Automobile sales, they're okay, but maybe not where one might expect. So it's the top 1% is they're changing how they're doing things, and that leaves everyone else. It's just really, truthfully, kind of going back to what I was talking about. I think they're out of gas, man.
Yeah, and
just completely out. Completely out of gas.
We've seen it in auto delinquency rates are ticking up. That is not something that's happening with high-end consumers.
No.
We're seeing. I mentioned it. FHA loans. I think a journal article said 79% of FHA loan holders didn't have 1 month of expenses in reserve. That, I mean, so if you even just have property taxes go up, I mean, then you're starting. I mean, if you have an emergency expense, all these things, we've seen it. Credit card balances and the ones that are 90 days delinquent there, all these rates are going up. And again, you have to you can't look in nominal terms. I think you need to look in terms of the total percentages. Sure. But even so, these are things that don't just typically tick up a little bit. I mean, it is a sign of a trend. And those are ways you can look at those lower end consumers. Those are the ones that are going to be delinquent on these loans. Those continue to go up and up and up.
Well, and then there's the issue of DOGE, the Department of Government Efficiency. And I mean, I think it's kind of amazing that Elon Musk and his minions have been able to root out as many glaring examples of inefficiency and arguably government waste as they have in a relatively short period of time. I mean, 1 month in or thereabouts, you're coming up with all these things, finding empty warehouses, finding just like, they haven't even done a deep dive yet, and they're coming up with some of this. And I wrote about it in last week's Common Sense, and the one that, I got some pretty good feedback on, about how this is going to cause some short-term pain for the economy. It's very necessary long-term, very necessary to get government spending under control. But in the short term, rooting out inefficiencies, that means paychecks. That means all that extra money. I mean, if Musk and Trump can find $500 billion this year, I mean, they're talking about $2 trillion. I think that might be tough. $500 billion bucks. Guess what, man? That's $500 billion bucks that's sloshing around. Someone's spending it.
Yeah, but that's in GDP too.
Yes.
So that's. I mean, we've talked about the equation for GDP before. That is directly coming out of our gross domestic product.
Yes. So
that's economic pain. That's exactly what you're talking about.
That's what I'm talking about, and all the paychecks. So, in order to get the government checkbook in order, that will cause some economic pain. I mean, it really will. And it's probably going to be more heavily focused on that middle class, that bottom. I mean, that's sort of that 50% median sort of type level. And it's not going to be that 1%. It's not going to be that 5%. What I really do think is going to happen over the next, maybe we push it out a little bit, but I started off the year saying the first 2 quarters were going to be much slower in terms of GDP growth than the back half of last year. And I might even push that forward a little bit because I just think the U.S. consumer is really kind of almost at a freak-out point.
Well,
and it's going to take a little while in order to get them to feel super good about going back and spending money with great aplomb.
Yeah, and look, there's plenty of waste in the government's expenditures, but there's these pure, truly, inarguably wasteful portions are not enough to get us down to that 3% debt to GDP.
No.
That's not even close. And so we've seen talks of, okay, where are these cuts coming from? In the areas you've talked or you've heard and been proposed are not areas that impact the upper end consumer.
No.
I mean, Medicare, Medicaid, SNAP benefits, these are things that impact the lower end.
Yeah. Yes. Yes.
And so it's like, okay.
Grandma's been dead for 6 months. You haven't told anyone. You've been getting her Social Security check. That's fraud. I mean, I can't help it. That's fraud. People living in the Hamptons probably aren't messing around with that.
No, but even the legitimate benefits, if we start slashing benefits, start slashing SNAP benefits, things like that. I mean, all these areas, once you get past the pure wasteful portion, and you start going beyond that, that is pure impact. That is a regressive tax on the lower end.
Yes.
And so, but how much of that can continue to be skewed in the data by 10% of people saying, if I'm in the top 10%, you could get rid of SNAP and it's not going to impact my life.
That's right.
So how much of that, which I'm not asking for that, but how much of that can be skewed by the data still?
Well, I guess you're asking a pretty good point. How much longer can the 10% keep on throwing a Band-Aid over the remainder of the economy?
And I think it's till the market falls apart. I think it's, I think people view it the other way around, that the high-end consumer starts to fall apart, and then... So
what you're kind of alluding to is, hey, we've had a couple great years in the stock market. People's homes are going up in value. Their balance sheets have gone up nicely. And as a result, they feel a little bit more comfortable to spend their cash. And they get those people that have those types of assets.
Yeah,
and so that top 10%. However, everyone else is just hand-to-mouthing it and just real anxious about what next month's going to bring. However, we get a 10% pullback in the stock market. We get something like that, get us back down to more reasonable valuations, at least by historical measures. What you're saying is that top 10%, maybe not the top 1%, which are almost immune to such things, but that 1 through 10%, if they pull back even their expenditures 5%,
yeah,
5%, that could have an enormous ripple effect throughout the entire
And I
economy.
think it's the same with corporations as well. I mean, 2022 is a perfect example of that.
Yeah.
These were companies that were over hiring for
just
multiple years before.
All that PPP money.
And then you even just focus on the big tech companies, which it's not localized to them, but you have these big tech companies that laid off tens of thousands of people. And when did they do it? When their stocks were down 30, 40, 60% for some of them.
Yes.
Not before. And so when you see some of these companies at all-time highs and going up every day, there's less incentive for them to lay people off, to show, hey, we're going to be reducing expenses, because the market is not demanding that from them. Yeah. The market demanded lower expenses in 2022, and then companies responded with it. And so it's this, cart and the horse thing, which is which. And I actually think that the market is what will lead things. If there's a slowdown, I think it's the market leading to those broader slowdowns than the other way around, than the high-end consumer leading the market.
And we're getting close to the end here today, but Sam, let me ask you this. We've seen the 10-year fall, 50 basis points over the last month plus, last 5 weeks. Is the bond market signaling that there is actually a slowdown in overall economic activity and that the stock market just hadn't figured it out yet?
People say that the bond market's a smarter market because it looks at balance sheets instead of cash flow. But, it's hard to, break down, okay, how much of this is people saying, hey, we think things are going to slow down, versus how much of it is, flows of money versus, animal spirits around what Doge is doing, because, it's not really impacting the bottom line yet, but maybe it's this fear of what's going to happen down the road.
Again, with the animal spirits, I think.
Yeah, so it's hard to know what to attribute it to, but if tariffs,
but 50 basis points in a month
it's significant, and there's been tons of articles about, hey, Besson is in Trump's ear every day, and having them focus on, there's the put, they say, on when there would be, the government steps in to support things, is around the 10-year maybe now, versus the S&P like it had been in the previous administration. And so how much of it is that this administration is laser focused on getting the 10-year Treasury down and wanting to go ahead and kind of front run that? I don't know the answer. But, it's something that's going to continue to be a focus for 3 more years, 3.5, 4 more years.
Well, it probably should be for 30 more years, frankly. But I will tell you this, there's enough out there right now for me to think that I don't need to change sort of what my contention is. Economy be slower in the first 2 quarters of the year. Walmart's sort of depressing guidance, what we've seen in the 10-year note, what I've been reading a lot, what I would consider middle-class restaurants having a lot of troubles. Some well-known names going through bankruptcy. All those things out there do continue to suggest to me the average American consumer is in a lot more pain than the headlines would lead us to believe. And at some point, it's we got to pay the piper on it, And maybe it is that 10% correction in the S&P 500 that'll take the top 10%, or at least 5 through 10%, going, okay, we're just going to slow things down for a couple of months. And when that happens, I think we start ripping off the Band-Aid on really what's been kind of clouding the overall GDP numbers. And that's decent growth by the top 10% and no growth by the bottom 90%. And once we get past that and kind of see a slowdown in that top 10%, I think it could be for a little bit of an ugly couple of quarters.
I agree. More volatile.
It certainly should be more volatile. And then please don't take anything we're saying here to be doom and gloom. I don't see 2008 or certainly let alone the economic contraction that we had in 2020 when we shut everything down. It's just been so long since we've had sort of what I would consider to be sort of a normal recession. Normal recessions in the past have generally been characterized by tighter monetary policy and fiscal restraint. And so what do we have right now? Well, kind of those things.
Yeah.
So in a lot of ways. So to think that we're just going to suddenly accelerate from here just because, I think would be a fool's errand. And as a result, I think the economy should cool off a little bit. All right. That being said, guys, we always love to hear from you. Also, if you have any comments or questions, please, by all means, let us know. As always, you can drop us a line at tradingperspectives@oakworth.com, or you can leave us a review on the podcast outlet of your choice. As always, if you're interested in reading more or hearing more of what we got to say or how we think, you can always go to our website, oakworth.com, oakworth.com. Take a look underneath the Thought Leadership tab and find access to all kinds of exciting information, including links to previous Trading Perspectives podcasts, links to our weekly newsletter / blog Common Sense, links to our quarterly analysis, all the various components thereof, as well as our quarterly magazine, Macro and Market, as well as information from our financial advisory group, headed up by Mac Frazier. They always have some good stuff in there. All right, with that, Sam, you got anything else to say about this interesting topic?
That's all I got.
That's all I've got today, too. Y'all take care.